Good evening, guys. Wednesday night, April 9th. This will just be a webinar going over questions I received from some of you guys. And if you have a chart you want me to go over or a question that you did not submit it, either post it in the questions on GoToWebinar or post it in the Watch and Trade chat room, and I will do my best to answer them. So just going to dive right in here. You guys should be seeing my second screen with primary time and sales and chart windows as well. So first question is, I have been waiting until the first 15-minute candle is formed before making trades to get a direction on the day. The only time I would deviate from this is if there was a significant momentum where the reward outweighed the risk. After watching your videos, you used the 3-minute candles. Is this just a difference in strategy or doing what works? Well, that video, first of all, is a little bit outdated. I used to really focus on the charts at the open, but now if you notice, I'm much more focused on time and sales and just watching the actual trades go through and what I refer to as the speed of the tape. You know, is it moving very fast to the upside, or is it moving very fast to the downside, or is it kind of like pettering back and forth, can't really make up its mind? As far as waiting for the first 15-minute candle to get formed, you use the term direction when you ask that question. So this tells me that you like trading directional movement. By the 15-minute mark, I would have thought that there had already been a decent directional move made. So I think that, you know, that's more of a safer play. It's more of a conservative approach. But if you want to really trade direction, in my experience, I tend to see a pretty solid directional move within the first 15 minutes of the day that you are not going to be able to identify by looking at the charts. You're only going to be able to identify by looking at time and sales and level 2 and just seeing how quickly things are moving and going from there. So, you know, my 3-minute candle strategy, made that video maybe 6 months ago. A lot has changed since then in my approach. So I still think it's a great strategy, but I also think that it's kind of a lagging strategy because charts are only going to show you what time and sales and level 2 has already presented. Next question. I'm a straight directional momentum trader, which probably isn't optimal because everyone else is looking at the same charts. What suggestions would you make, if any, to improve this strategy? I consider myself the same, to be honest with you, so I think it's a fine strategy. The only thing is you need to know when you're able to use it. You need to know when you can be a directional trader. It's a good strategy. Where people go wrong is they want to be directional traders when there isn't direction in the market. The last few weeks, if you just look across the board, has been very, very good across a number of stocks. Netflix, clean directional move down. Amazon, clean directional move down. Google, well, Google not so much really. Priceline, clean directional move down. Those are good examples of directional movement, but it's not always like that, right? If you look at this Priceline daily chart, you can see, you know, right here was a period where there was not very good directional movement on Priceline back in December. Back here, late October, there was not very good directional movement. And if you're trying to trade that as a directional trader, you're going to get chopped up. Same thing on Tesla. Tesla is a very directional stock, but it too has gone through periods of lack of day-to-day direction, where if you're trying to trade that, you're going to get kind of screwed. You need this diagonal movement from Tesla, right? You can't be trying to trade this right here or back here. So the question is, what suggestions do I make to improve this strategy as a directional momentum trader? My suggestion is get better at identifying when there is direction in the marketplace and be able to identify when there is not direction in the marketplace, because when there is not direction in the marketplace, you will not be able to successfully trade movement, momentum movement, because it simply won't be there. Next question. Do I pay attention to moving averages? No, I do not. I don't think you've ever seen me, or anybody who's been a member has ever seen me use moving averages on my chart analysis. My reasoning, nothing against them, but just personally, I feel like if I'm relying on moving averages to kind of build my thesis, number one, I'm probably a step behind. Number two, I'm probably a little insecure about my own ability to analyze price action and form theses for expected direction. I've just never found myself, when looking at a chart, to be like, I wonder where that moving average is at. I just look at a chart and I see, all right, is it making higher lows or higher highs? Is it in an uptrend or a downtrend? And where is support? Tesla supports at 203, last week's low. Netflix support is this week's low, 331. And you know what? If the moving averages so happen to be there also, then cool. I don't really care. I'm not, if I need to use a moving average to be able to identify support, then I must not be very good at identifying support. Because remember, moving averages and any indicators are based on price to begin with. They're based on price. Sometimes they're based on how quickly prices were achieved. So if I just look at the price of the stock itself, I should be able to identify the same thing that a moving average is going to tell me. I would bet, okay, Netflix has made a big move down. Amazon has made a big move down. I would bet if you looked at daily charts of these with moving averages, I would bet that both Netflix and Amazon are near a important, quote-unquote, moving average like the 50-day, 100-day, or 200-day. Typically, anytime you get a huge move to the downside on an uptrending stock, it's probably going to be approaching one of those moving averages, or maybe even below them. Next question. When entering the day, do you use the previous day's close as your stop loss / entry point? Are you looking, and it was kind of a twofer, are you looking or making any judgment based off of pre-market activity? And I like that second part of the question, because you answer your own question with your second question. My stop loss going into the day is typically based on what I'm seeing pre-market. All right, if a stock is near a reference point pre-market, for instance, Amazon today was, well, no, Amazon didn't gap, so that's not the example I'm looking for. But if a stock is gapping up or down to a reference point, and I'm seeing it pre-market around a round level, for instance, maybe Google gaps up tomorrow towards 570. Yesterday, Google gapped up right on top of 545. My stop loss is kind of based on that round level action. It's about determining my reference point that I am nearest to, where if I enter the trade, I know that, okay, Google gapping to 545, so I know if it can't hold 545, I need to get out. And if it can't hold 545, then I'm looking for a continued move in that direction. Stop losses as a day trader, I'm always coming up with them minute to minute, hour to hour, day to day. So I certainly pay attention to what the previous day's close was, and if it's holding in the green or is it holding in the red. But as far as stopping myself out, I really never, again, kind of like the moving averages, I don't reference exactly, all right, this was the previous day's close, so that's where it needs to stay below. I just reference, all right, this is where I've identified support and resistance to be. So if I get a setup at the open where it's trading around one of those reference points, either on the support or resistance side, then I can trade it versus that level. For instance, I took a trade today on Tesla. It was versus 215. Tesla had pulled back to 215. I don't think Tesla closed, 215 action. It's just a round level. I wasn't trading versus 215 today because it was a previous day's close or anything like that. It just so happens usually that good setups come out around break-even lines, like if you're holding in the green or if you're holding in the red. You hear me say that sometimes, that, oh, I'll stay in this long trade as long as it holds green, or I'll stay short as long as it holds red. So that's where I'm referencing the previous day's close kind of indirectly, but going into it, I've identified the reference point pre-market or during market hours. It's not something where I go out of my way to be like, all right, well, where did it close, And if there's any questions about any of these answers throughout the course of this, go ahead and make those, and I will do my best to discuss them further. Next question. Do you trade upside for about 5 minutes anytime during the day, or do you only look to take advantage of the huge volume at the open? Well, I'd like to think that I'm looking to take advantage of a big move whenever it happens. If I'm around and I'm behind the computer and I see a big move in the works, then I need to try and trade it. In my experience, the best consistency of a move is always at the open. Typically the open, it's when you trade the most volume of the day, as this question notes, and the most money is involved right at the open, so that's when usually there's going to be a first directional move. If there's going to be a directional move on the day, it's probably going to show itself within the first minute or 2 or 3 of the day. And if nothing big has happened, at the open, and then nothing happens 10 o'clock and 11 o'clock, then I generally feel like there's not going to be a big move on the day overall, unless it's a news-driven move. Today was a good example of that. We didn't have very good movement at the open. If you just look across the board, you'll see that Netflix moved lower, but then kind of slowly drifted lower, but was mostly sideways. Amazon was very similar to Netflix. Google was very, very choppy off the open. You had some downside, but then everything came back up, so it didn't really commit. But then we had a news-driven catalyst later on in the day. We had the FOMC minutes, and that was a catalyst for upside. 2 o'clock, you see Google made a nice move. The best example here is Priceline, which at 2 o'clock made a really solid move higher. All right, so you need to know when there is a greater likelihood of a move kind of setting up later in the day, such as a day like today, or a day when Janet Yellen is going to be making a statement in the middle of the day, something like that, or if there's a data point coming out at 10:15 or something like that, or the European close. Just need to be able to identify stuff like that. Otherwise, I generally feel like that the best movement is going to happen at the open, or the best setups are going to be presented around the open, meaning that, okay, maybe there's a move at the open that I don't catch, but it sets up a secondary move. And we'll stick with Amazon for an example. All right, because Amazon earlier in the week gave all types of movement. All right, so like you look at Amazon, this was on Monday. Amazon, good move down off the opening price, then a big move back higher. All right, so right away at the open, it showed me a solid move. You went from 320 to 316 in the first 10 minutes, a nice 1% drop off the bat, really 321s to 316s. Then it shows me another big move. It goes from 317s up to 325s. Okay, so by 10 o'clock or so, Amazon has showed me that there is big move potential. It moved big to the downside at the open, then it moved big to the upside ahead of 10 o'clock. So my thought process at that point is, all right, there was a lot of volatility here, so there's a good chance that there's another big move coming, right? That's the way I think anyway. And then, sure enough, later on in the day, well, really not even that much later, 10:15, 10:30 or so, Amazon starts just a huge move lower from 324s to 313s. Now, let's compare that to yesterday. Amazon opens up, right? Opens 322, stays right around 322 within the first 10 minutes of the day. Makes a little bit of a move back lower, goes from 324s to 320, okay, but that's not nearly the move that it made on Monday. Then it goes back from 320 to 325, so again, not the same type of movement it's making on Monday. So Tuesday compared to Monday, Amazon's making big time moves on Monday first 30, 45 minutes of the day, and then on Tuesday, Amazon, it's still moving a little bit, but it's much smaller percentage-wise range movements. Then look how that unfolded to the rest of the day. Yes, you got to move back up 321s to 326s or so, but look at the rest of the day's price action. It was very, very sideways. So flatter price action or less volatility the first 30 to 45 minutes of the day from Amazon on Tuesday showed that it wasn't going to be as volatile overall as it was on Monday. And that's really what I look for off of those opens, is I look for, number one, pre-market. Am I seeing volatility pre-market? Number two, do I have good volume once the market opens? Number three, do I have good movement right away off of the open or movement relative to a round level reference point? Next question is about the 5 to 7 primaries that I trade, asking are those the only options I trade, or are there others that I look for? If so, what do I look for when searching for an option? This is a question I get asked a lot, and rightfully so. People probably think I'm crazy following the same stocks every single day. And the analogy I like to use for it as to why I follow these is that stocks are kind of like your best friends. You don't have a ton of best friends. You don't have 20, 30 best friends. You've got 3, 4, or 5 best friends maybe at the most. And you know everything there is to know about that best friend. When their birthday comes around, you know what they want for a present. If they want to go out to eat, you know what type of food they want. If they want to go to a party, you know what type of party they're trying to go to. Stocks are the exact same way. The more you hang out with an individual stock, the more you understand where does that stock like to go. Where a stock likes to go to eat is essentially like saying, okay, every time it gets near 350, it's getting rejected, or every time it gets down near 320, it's getting bought, something like that. All right, so it's just really a comfort thing where you start to notice intricacies about these stocks and you get a feel for the way they move. You can tell when they're in a certain type of mood, right? You can tell when your friend's pissed off. You can tell when Amazon's about to drop 30 points. Well, that's a little too much. You can tell when Amazon's about to drop 15 points. You can tell when Google's getting ready to rip 20 points, And that's the type of stuff that I wouldn't have a good feel for, at least I don't think I would, if I wasn't watching those same stocks every day. Now, I am trying to get better at expanding my primaries. Recently I was only trading on a laptop, so I didn't have a good setup really to manage everything. Now I've got 3 screens, much better broker, and I have an ability to keep track of a lot more. So I have, as of this week, actually started following SCTY and FSLR. I've got another screen going here. And, you know, because I do, obviously there's more opportunities than just these 6 stocks that I'm following. So yes, you know, now that I have a better means for keeping track of everything, I have started to try and follow more stuff. As far as what do I look for, the main thing I look for is a history of big moves. A history of big moves has to be number one because I'm a directional trader, so I need to know that there's a history of directional movement. So if you just look at SCTY, you can see pretty clearly why I might like it. You see that this stock, you know, has gone from $30 in September up to $85 in late February, early March, and now it's come back down to $55. So this is a major directional move up and then a major directional move down. The other thing I look for is increasing liquidity, okay? Meaning that as the price is going up or down, volume is coming in or out, showing that there is an increased interest by the market to trade this thing or invest in it, all right? And you see that exactly in SCTY. You can see back in May a little volume increase, and then again in October volume got really big, and then more spikes in March. You'll see those two same exact things on FSLR. I said directional movement and increasing liquidity. FSLR has gone from $35 up to $60 from September to November. Then you went from 60 down to 45, and now recently you went from 50 up to 70. So big time directional movement. Then I want to see increasing liquidity. You've got liquidity spikes here in October into November, then another spike in February, and then just awesome liquidity here in March. The other thing in addition to that that's more of a variable is the price of the stock. I generally want to trade higher price stocks, you know, $50 and above. And the reason for that is there's a couple of them. Number one, there's more strikes to choose from. So I can make a better decision as far as, okay, how far out of the money do I want to be? Do I want to be in the money? There's just more choices, all right? I like choices in the market. Number two, the percentage moves in between those strikes is smaller the higher price you get. I'll show you a perfect example of what I'm talking about. If you look at Google, Google has a 565 strike, 567.50 strike, 570 strike, 572.50. Every $2.50 there's a strike on Google, right? So $2.50 divided by 565, you're talking about a percentage move of 0.4%. So if I'm out of the money, maybe I'm playing the 570 call on Google, and the stock's at 567 right now. The best scenario on an out of the money call is what? When it goes in the money, all right? So I'm in a 570 call. That means I only need Google to move 4.4% in order for my strike to go in the money. Let's compare that to Bank of America, a popular low-priced optionable stock. Bank of America, same thing, 50 cents in between the spread, right? So it's at 16.60. So I need to go in the money, I need to go from the 16.50 strike to the $17 strike. All right, so only going out one strike, just like on Google. However, because the price is so low, now I have 3% in between the spread, in between the strike, from 16.50 to 17. So now, instead of only needing Google to move 0.4% just about in order to go in the money on my out of the money call, now I need Bank of America to move 3% in order to go from in the money to from out of the money to in the money. We'd all agree it's much easier for a stock to move 0.4% than it is 3% whole. Obviously, though, there's advantages and disadvantages. You look at the BAC 17 strike, it only costs 3 to 4 cents. Okay, so if it does go in the money, that's going to be an outsized return. You're only paying $4 per contract to own that, where with Google, you're having to pay, or $40. No, yeah, $4. Whereas with that Google example, you're having to pay, what, $350 per contract. But, and I'm not going to get into this insanely, the delta on Google is higher. You're talking about a 41-cent delta on that same Google example, where the delta on BAC is, I believe it was, what, 18 or so? Yeah, 18. So there's advantages and disadvantages. It just really depends on your comfort level. But for me, you asked what I like, what I search for. I search for the higher price because there's more strikes available, and I need less percentage moves for one strike to go from out of the money to in the money and vice versa. This is a question that I touched on some in our live session the other day, and that is, what is my opinion of a high delta strategy versus a low delta out of the money strategy? So referring to, is it better to trade in the money calls or puts that have higher deltas versus playing out of the money calls or puts that have lower deltas? The advantage of the in the money is that you only need the stock to move 1 point and you're going to catch a nice return from the delta. The advantage of the out of the money is if the stock does move in your direction, gamma and delta is going to speed up, so your return has a greater chance of being, of outperforming the in the money option. So again, pluses and minuses to either, which is why, as always, my first thing that I'll say, do what makes you comfortable. Do what makes you comfortable. But make sure you understand the upside and downside to either strategy. Make sure you understand the upside and downside to either strategy. If you're trading higher deltas and you're not understanding or accepting of the fact that your dollar losses are going to be greater when it goes against you, then, you probably shouldn't use that strategy. If you're trading out of the money and you're not understanding of the fact that your percentage losses are going to be greater if the trade goes against you, then it's probably not for you again. But as long as you're understanding of it and you're comfortable, then I recommend testing out either one and seeing which one you like better. Personally, myself, I like the out of the money because I can gain exposure at a low dollar cost per contract, not low in premium necessarily. And, in the age of the high-flying Momo names and just huge moves, I've seen out of the money percentage gains definitely justify playing them, but I've also seen out of the money percentage losses validate exactly why you need to cut losses quickly in those positions. I started trading in 2008, 2009, so I've seen a big move over the last few years. So, my answer might be a little bit different if I was trading from 2003 to 2007, but I'm a product of the times I've been trading in, and, too many Fridays have come and gone where I see an out-of-the-money option is up thousands of a percent. That's always what I'm going to shoot for until something changes. But bottom line, what do I think of the one strategy versus the other? I think if you have a larger portfolio, then it probably makes sense to do the higher delta strategy. If you have a smaller portfolio, you probably want to be the lower delta strategy. I don't think one is better than the other. I don't think any strategy is better than the other. The only strategy I think is better than the other is if one strategy is making you money and the other strategy is losing you money. So track your gains and losses. Take notes. Try a high delta strategy, see if you make money. Try a low delta strategy, see if you make money. If they both make money, pick and choose. If one makes money and the other loses money, then go with the one that's made you money. If they both lose money, then it doesn't have to do with the strategy. It has to do with your execution and how you're observing setups, and that's a whole other discussion. This is a good question that I have here with a very simple answer. When would you suggest absolutely not trading? Number one, whenever you feel like it. If you ever aren't in the mood to trade, don't trade. If you're ever feeling sick or groggy or just something in your personal life has got you distracted and you're just, you're not excited to trade, then don't trade. So that's the emotional answer. The technical answer is a day like today. The morning action was very choppy. Up, down, up, down, up, down. And the analogy I'll use is coloring between the lines. Trading should not require that you color between the lines. Trading should allow you to scribble outside the lines sometimes. If you can't find setups where you don't think you can scribble outside the lines a little bit without getting burned, then you should not trade that type of market environment. I want to be able to trade when I can do a little scribbling outside the lines and the teacher isn't going to yell at me. And by the teacher, I mean the market isn't going to force me to take a big loss. Another question, how much of the entire chart do you look at and take into consideration for day trading? Do you look back a month, a year, etc.? For day trading, I look at what you see on my screen every day. The daily, the 3-minute, the 15-minute, and 60-minute. I like using these charts kind of in concert with each other. I like using the intraday for kind of the immediate term. Where do I think it's going to be 5 minutes from now, 10 minutes from now, 15 minutes from now? But I like using the daily also to get a feel for the overall trend. That's why in the afternoon sessions, you always see me check up on, the chart and, hey, do I think it looks good for a gap higher or a gap lower? Kind of where are we at going into tomorrow? I'm not going to take a position overnight because I like what I'm seeing intraday on a 15-minute, 60-minute chart. I have to like what I've seen on the intraday charts and then confirm it when I look at the daily and then say, okay, yeah, there's a good move here potentially into tomorrow, and I can take that. As far as looking back at monthly and yearly, I 100% think that those charts are very necessary for day traders. But I think that what they're good for isn't so much right here, right now, where's it going? It's more about the intermediate term trend. What's my overall bias on the stock? What's my underlying thesis? We talked earlier about underlying strength and underlying weakness and, wanting to go long a stock that has underlying strength during a period of weakness and wanting to short a stock that has underlying weakness during a period of strength. That's where I'll use the weekly and monthly chart to kind of make those determinations. I probably check out a weekly chart, a couple times per week just to see how this week's candle is shaping up going into next week. I probably check out a monthly chart maybe once per week at the most. I'm really not checking it much more than that. So that's that exact answer. But I'll show you some examples of, using an underlying trend to identify, or using a longer term chart to identify an underlying trend. So let's look at Tesla. Tesla's my first example. Now Tesla is going to be my example of an underlying bullish trend. So not only do I have a solid uptrend here on the daily, all right, so that looks good. So why am I still bullish on Tesla even though this thing has gone from 260 to 200 over the last month and a half? That's a drop of 20 to 25%, okay? I see a lot of people shorting Tesla. Why are they shorting it and why am I still going long the stock? Well, when I look at the weekly chart, I see a couple things. I see a stock that is very much in a long-term uptrend right now since last year. Number two, I see a 4-week pullback that's failing to go down a 5th week in a row. Also, you'll notice that the only other time in the $100 in the $100 range that Tesla had a pullback of at least 4 weeks, it was here from October 2013 to November 2013. And that losing streak on the weekly chart ended up being a bottom for the stock and was a buying opportunity. Here we are again, losing streak on the stock, and you're starting to find some support. So it looks like a possible buying opportunity. I'll show you another thing here that I noticed on the weekly chart. You look at this high here in Tesla from April. All right. Look at then where Tesla pulled back in October 2013. It pulled back right to that high, held it, previous resistance, acted as a new support. Now you see this high in late October or early October, late September. Tesla pulled back from that high. We've since gotten above it. Look at where Tesla has pulled back to on this weekly chart, right on top of that previous high. Another instance now of previous resistance being possibly new support. So to me, that is long-term bullish and supportive of higher prices on Tesla. Now, that's where, overall, even though the stock's declined over the last couple of weeks, I view it as a pullback within a longer-term uptrend because of what I see on the weekly chart, and the monthly chart would show you the same thing. So that's a bullish example. Now let's look at a bearish example with Amazon. I'll answer that question in a second. All right, Amazon, same thing, weekly chart, okay? Again, a clear uptrend here. So you say, well, what's the difference? Why are you now intermediate term bearish on Amazon? Well, let me point out some differences. Number one, you just had a hard pullback, right? And while you bounced, you ended up pulling back even further below that low. So that's the difference in Amazon. When you look at the recent history, you look at the losing streak that Tesla had, the big drop lower, it was able to bounce and make a new high. Amazon just had a big drop lower, bounced, and then made a new low. That's right off the bat. Number two, here was an area that represented a high on Amazon, the October high, kind of actually similar to Tesla's high from a timing perspective. Amazon, however, was not able to hold this high as support. In fact, this high actually kind of ended up being resistance from Amazon when it made a back test. All right, so now Amazon to me looks like it is in a downtrend on the weekly chart. It experienced a losing streak, it fell back, and now the losing streak just the last few weeks continued off of that high. So we've had continuation to the move lower, where Tesla looks like it's been able to stop the move lower. So that's why I am looking at Amazon as intermediate term bearish here. All right, my final example, the one everybody forgets, neutral. Apple is the neutral example right now. Apple has been an awful mover on the weekly chart. Oh, that's not Apple, that's the S&P. All right, so here you go. So you look at Apple right now. Big move up, big move down. However, since October, if you look at this thing, you have simply been in a channel between about 500 and 550 on the weekly chart, with a brief move above 550 and a brief move below 500. You do not have a good streak, meaning that, you had a losing streak, yes, but then you recovered and kind of just been going sideways. Apple is not below its 2014 low so far. It's not above its 2014 high. Both Amazon and Tesla were either above or below its recent highs or lows. It's not above its October high. It's not below its September low. Amazon, Tesla were both either above or below both of those. All right, so Apple has displayed sideways price action, hasn't showed good directional movement. And, that's why it's neutral. Now, David asks, do I think everyone sees the same thing? I don't. That's like, looking at a piece of artwork and thinking that everybody sees the same thing as you on abstract art. Charts are abstract pieces of art. We can all interpret them differently. They all mean something different to us. So, no, I don't think everyone sees the same thing. And, there's only one way to tell if the person who sees one thing is right, and that's just letting the price action unfold and seeing if it goes in that direction. I wouldn't worry so much if everybody sees the same thing. Who the hell cares if everybody sees the same thing? Everybody watches the same basketball game, but they still pay, a lot of money to go watch the game played live. Trading's the same way. We're all watching the same game. Who cares? Let's just try and play it better. Next question. What is my strategy for trading gaps? Now, this is a very, very open-ended question because there's so much that goes into a gap. Is it an earnings-related gap? Is it an analyst upgrade? Is it technical? Is it market-driven? Okay, so a lot of different factors come into play. So I'm just going to kind of ignore those because I don't think that's the answer you're looking for. But the one thing I want to say about that is you should understand when there's more likely to be a bigger gap, and a bigger gap is not necessarily likely to result in a bigger move, but it may. So if a stock has earnings coming out, it's probably going to gap one way or the other. But again, just not going to talk much about that because that's so case-by-case basis. Now, the first thing my strategy involves, number one, is it gapping above or below a meaningful level? Okay. We had some market gaps recently. All right. Tesla's a good example. Tesla's always a good example these days. Oh, shit, what happened? All right, come back to you. All right. All right, scratch Tesla. We're going to use Netflix for an example. All right, so Netflix, huge gap, right? Okay, this is in January, earnings-related gap higher. But if you look, this gap wasn't above resistance. It took it right to the all-time high. Huge gap, volatile price action, but at the end of the day, you didn't really go anywhere versus its opening price. However, then you broke out and made a new all-time high, and then you consolidated. And this is the gap that I want you to look at from early February. All right, Amazon consolidated. That was a breakaway gap. That was a gap above resistance. That was a gap clearly above resistance where my strategy on something like that is, number one, the stock's near an all-time high and it's consolidating. So I'm already waiting for a breakout. That's just how I have to be trained as a momentum trader. So number two, I see this gap happening pre-market. I remember this day exactly. I actually took calls and sold way too early. But that's neither here nor there. Netflix gapped up, and what I think to myself is, all right, if it's gapping, if it's breaking out, if it's going to run, there is no reason that this thing should not just break away and really run hard and be able to hold on to a good portion of this gap. That's the first thing I'm looking for. If you have a gap higher above resistance or a gap down below support, I need the stock to hold on to majority of the gains from the gap higher or hold on to majority of the losses from the gap lower. All right, so Netflix on February 6th closed at 408. On February 7th, it opened at 413. So you're talking about a gap of over 1%, very solid gap. The stock pulled back to, it opened for 413.50 and it pulled back to 410.50, okay, but then was able to recover right away. and get back near its opening price. So I see a gap higher and I see it hold on to the majority of those gains and get back above its opening price. Now I know it's ready to rock and roll. The reason you're going to know that a stock is holding on to a majority of its gains or losses is because it's going to either be able to come back above its opening price or below its opening price if it's to the downside. That is, the opening price is extremely important when you have a gap. All right, it's extremely important. Do you spend time above or below the opening price? And if you come below it, do you stay below it, or are you able to get back above it? Now that I think about it, today was actually a great example of a gap in Netflix where it was unable to stay above its opening price. So yesterday Netflix closed at 348.90. Today Netflix opened 351. 4-point gap higher, 1% gap. Right away though, Netflix filled its gap, and you can see that it wasn't able to get back above its opening price and whip back higher. You ended up having a slow drip lower. Some gaps I'll simply stay away from. This is why afternoon analysis is important, is that in the afternoon I'll look to go into the next day with a thesis. Like today you were here and I was thinking, I was trying to fill Google, right? Remember that? I was trying to fill Google for an overnight position. So now if Google gaps up tomorrow, that's something I was already looking for. So I'm definitely going to be focused in on Google and watching that opening price action. Otherwise, if I wasn't expecting the stock to gap, if I looked at the daily chart the previous afternoon and I said, no, I don't really see a gap here, and then it does gap, then I kind of stay away from that and let it play out. But if it's a move that I've kind of been stalking and had a feel for, then I look to get aggressive into that. I think that gaps offer some of the best trading opportunities, but it's very, very important that you strategize for them based on pre-market action. If you think about what a gap is showing you early conviction by the market in one direction or the other. I see you mentioned that you're having trouble on SPY sometimes when it gets gaps. I'll tell you personally, I used to trade SPY a lot in 2012. I stopped trading SPY. I just never really built a consistent track record on SPY that I could look to and say, yeah, you do well trading this thing. And that's when I just shifted into individual stocks. SPY is almost too liquid. It's what I refer to as botted up. There's so many damn algorithms and HFTs on that thing where it's like it'll drop 30 cents out of nowhere, then recover just as quickly, where I'd rather just trade individual stocks that are going to move, that are maybe going to be swayed by the market, and they'll make a directional move off of that. Overall on gaps though, also, don't be afraid of a gap. Don't be afraid of a gap. There's really good volatility typically off of a gap. Some of the best trades are when a stock gaps up and then goes red, or when it gaps down and then goes green, stuff like that. But my strategy is to really observe pre-market action, try and get near a reference point. Again, that's why I said, is it gapping above resistance or below support? That Netflix example that I was showing, so on this day, I didn't, the February 7th, Netflix opened 413, hit 410.50, closed 429. I didn't buy Netflix until it got above 415. 415 was just kind of that round level, all right? And, Google's going to be the same way. If Google gaps tomorrow, I'm going to wait until it shows me stability above 570. That's just that round level that I'm watching, all right? Because if it gaps, but it's gapping to, the middle of nowhere, then, I mean, what? If it's not near a reference point that I can trade against, I'm not just going to get in and hope for the best. All right, so this is probably the best question we've gotten. What advice would you give people like me? I will be retiring from my job in a month or so. I'm only 45 and I'd like to trade to supplement my pension with some discretionary funds I set aside and keep my mind sharp. I'm sure I'll work somewhere else in the security sector part-time or as a contractor later on, but I really enjoy trading. What is your advice? Well, I'm not gonna go into cliches with this answer. I mean, you know, don't trade with more than you can afford to lose, shit like that. Whatever. We all know that. What I'll say is you've got to be comfortable at all times. And in your life, there's probably been many instances where you were uncomfortable and unsure about what you were getting yourself into. Some serious, some probably not so serious. Maybe it was a relationship, maybe it was picking a job or where to attend college, or maybe, like I said, something stupid like where to go to eat or what to watch on TV. Chances are you were nervous about those types of decisions, the more serious ones anyway, prior to making it, and you inherently accepted that if this goes wrong, if this ends up being the wrong decision, I understand that. I understand that that's very possible that this will be the wrong decision. Things might not go as planned, and I might end up being disappointed. All right? Trading is different to that, but it is also the same. It's different because in trading, you should never feel uncomfortable or nervous. You should never accept that I have uncertainty and I have, nervousness surrounding this decision, because that is called fear. That is all nerves really are. We like to use the word, oh, I was a little nervous when I was in a trade. No, you weren't nervous. You were scared. That's really all it's about. You shouldn't be scared before you enter a trade or when you approach trading, because nothing good will come out of being afraid of anything. You should have high conviction that you can do this, okay, that you will make the proper decisions, all right? And this is where it's the same, that when you realize those decisions didn't work out, you will be accepting of the fact that there was always a chance that it wouldn't work out, and you won't view your decision with regret, anger, or a desire for revenge, because you'll trust yourself that, hey, I've identified this was the wrong decision, so now it's simple. I got to get out. I got to cut a loss. So it's different in the sense that the things that make you nervous in life, you can't accept nervousness during trading. You won't execute as well as you need to if you do accept that. But it's the same in that if you do end up being wrong, just like you've been wrong about some of the decisions you made in life, there's a simple way to correct it. You just get out and take a loss. And once you do that, you reevaluate. I used to think as a trader that it was normal to be a little on edge, at the edge of my seat when I was in a trade, that, that was kind of the adrenaline and whatnot. But now I don't think that anymore. I really think that I need to be comfortable at all times. As soon as I start to feel uncomfortable, I exit a trade, because I trust myself that, I'll get back in if I need to. And if I don't get back in when I need to, or I don't get out when I need to, then I accept the fact that I'm simply not good enough at trading yet, but I will be soon. You need to be accepting, and where people in your situation I think go wrong is they get disappointed and they let disappointment discourage them, or they let it cloud the fact that if you were wrong, that means all you needed to do to be right was do the exact opposite thing. So that would be my best answer for that. And that was all the questions I received. I didn't have any chart requests. So are there any questions on anything that was discussed? This was recorded, so it will be posted on the website, and I'll email it out to you guys as well. All right. Thank you guys for attending. I really appreciate it. And I will see you. Oh, Michael's got something. Oh, nope, just saying good job. Thank you. Of course, guys, you're welcome. Thank you guys. And I will see you tomorrow morning at 8:50. Have a good rest of your night.